Welcome to BST Live. Glad you could join us today. Welcome to the show for systematic and algorithmic traders. Today, we're going to be talking about trend following. How can we make it better? Well, let's get to it. Well, good morning, good afternoon, good evening. Thanks for joining us today for this fine day here in Melbourne. It's quite sunny. It's a bit cool, but it's going to be a good day. Today, we're going to be talking about trend following. And our guest joining us today is Dave Lundgren. Welcome, Dave.
Andrew, nice to see you. Thank you very much. Thanks for having me on.
Yeah, it's great that you're here today because I know we were scheduled for a few weeks ago, and I've obviously moved house, and we had some internet connection problems, and you're very gracious to move to another day. So welcome today. I'm glad you're here. So thank you very much for that. So
of course, it's my pleasure. I was looking forward to being the first guest in your new home, but Brett Steenbarger upended me on that. So
yeah, he pipped you to the post. So apologies for that, but thanks for joining us today.
No worries.
Now, where are you?
Of course, I'm located in Maine, in our vacation home in Maine.
Okay, excellent. Sorry, we're just having a technical issue there, but I think it's caught up now. So you're coming to us from Maine, was it? Sorry.
Yes, from Maine.
Okay, excellent. All right. Well, looks like everything's running clear now, nice and clean.
Very nice.
I can see it's going through. So let's get to the show. So apologies for all that mix up now. So how about we start first? I know you've got some great stuff to share with us today, and something that people might even think is a little controversial, but we're going to get into it in a sec. But how about first, can you share a little bit of background on yourself so that people get some context of where you're coming from and what you're going to share with us today?
Yeah, of course. So, I mean, I've been in the business for about 30 years. My first job was actually as a stockbroker up in Canada, and my wife to be then was finishing up her schooling and whatnot. So I moved up there expecting to be there permanently, and events unfolded in such a way that I ended up coming back here. But in that job at Dean Witter as a retail broker, I ended up actually sitting next to another broker who managed his entire book using technical analysis. So it was mostly risk management, looking for buy ideas, but also vetting the brokerage firm's buy recommendations through the chart. So he wouldn't buy a buy recommended stock unless it had the proper trend set up and things like that. So up until that moment, I had no experience whatsoever or knowledge really of technical analysis and whatnot. So I just saw it come to life right in front of me, and so I've been hooked ever since. And over the years, I've been on the technical team at Fidelity, which was my first sort of indoctrination into institutional money management, where the mindset is fully invested in relative performance and things like that. Prior to that, it was mostly futures trading, which we can talk about, and left Fidelity to start a hedge fund with a few folks from Fidelity, which was a great learning experience as well. All of these things we can talk more about if it comes up. But left the hedge fund to start my own research firm, Breakaway Research, which that's really where I started to really get into. I would, especially given your audience, I would never say quantitative investing or systematic investing because I'm aware of my audience here, and so I don't have a PhD in anything but. In investments other than from the school of hard knocks, just learning it the hard way and whatnot. So, but to the extent that I'm a systematic investor, which I would consider myself very much systematic, it was with my own firm where I developed the models that I currently use today. And through those models, that's how I found myself at Wellington over a couple of years. They were my client, and they eventually convinced me to shut my firm down and join Wellington, where I was there for 13 years as a co-PM on the portfolio, and then advising other portfolio managers on their holdings. And for me, my big change today is having left Wellington in December. I am now making this cavernous change in my life from being one who manages money for others to trading for a living, which is pretty exciting, very, very, very different, all of which I expected, but it's just different in different ways than I expected. Yeah. But I'm pretty excited about it and looking forward to it. So,
yeah. Okay, thanks for that, Dave. You've obviously got a lot of experience, and don't discount the School of Hard Knocks. I think that's a very valuable way to learn.
Right.
So when we were, I guess it was probably about a month or two ago now, we were talking about what topics we could discuss on the show today, and you said something that really, picked up my interest straight away. I was like, "Hang on, what did you say?" The quote you mentioned, or the term you said, is momentum doesn't work. Now, I know that there's a lot of people who subscribe to momentum and trend following, and so it's probably going to sound a little bit controversial. So why don't we dig into that one straight away? Let's get straight into it, I think. So why do you say why do you say momentum doesn't work? What do you mean?
I mean two things. One is maybe if you go to the second page of the slides that I sent.
Sure. Let me get this one here.
Actually, maybe go to the next one, because it's marked up a little bit more, and we can kind of just jump right to it. So,
okay.
So I'm sure most of your viewers and followers are very familiar with the momentum factor. So I won't belabor what it is or what have you. But what this chart is showing you is the 10 deciles of momentum back to 1927. Those that are interested can get this data directly from Ken French's website. It's where I got it. And all I did was convert the monthly stream of returns into a portfolio for each decile and just plotted it. So here you can see it. And so a couple things jump off this chart to anybody who would look at it pretty readily. One is that most of these, if not all of these deciles, are up and to the right. So over time, there's a upward drift to the equity market, which we know the pink line in the middle is the average return, which would represent the market. But what's really interesting about the momentum factor is that when you do decile the market based on its historical returns, and then invest in each of those deciles separately, it turns out that the forward returns of the decile based on preceding history actually matches the decile it started in. So in other words, the idea is that if you invest in that top decile of performance, that top performing decile continues to be the top performing decile, which is not always like if you look at value charts that are similar to this, that it's much more like a bowl of spaghetti, in a sense that if you buy the seventh decile of valuation, like the seventh cheapest value decile, it doesn't necessarily become the third best performing decile going forward. It kind of goes underneath. And so you can see here that these are almost in rank order of the decile they started in, which is, I think, pretty fascinating. So, but you just look at it, just generally speaking, and you can see that momentum, quote unquote, works. So there's two things that I would say, and when I say momentum doesn't work, first of all, again, I've been looking at charts for 30 years, and I just have a curiosity. I'm always looking for these anomalies within the chart. And when I was looking at these charts, putting them together for you, what struck me was if you look at the far left side of the chart, you can see that the most of the decile returns basically went sideways. So in that window of time, momentum didn't work. You'll note that the top line, which is the orange line, that's the top decile versus the bottom decile. So that's the best momentum versus the worst momentum. It did work through that period, but you'll notice that it was quite volatile and actually had a lot of overlapping structure during that almost 20-year period. So it worked, but it kind of didn't work. And it was kind of hovering below its peak from 1929. So you could make the case that even then, that decile of momentum, that comparison didn't work then either. And then when you look all the way over to the right, we know today, we hear a lot of people talking about how momentum's not working today and it's struggling and things like that. You can see that in this chart. This is, again, showing you the best decile, the decile 1 versus all the other 9 deciles. In the top, the orange line, that's decile 1 versus decile 10. You can see that it's got an upward drift to it, but you can see it's laboring and it's very volatile, and there's a lot of sudden givebacks and what we call momentum crashes and things like that. And then when you look at decile 1 versus the other deciles, you can see that since the tech bubble, it's basically been a knife fight. I mean, there's been no real winner. You can't really say that decile 1 has been a big winner against any of the other deciles. So this is why we say today that momentum hasn't been working, and you can see that pretty clearly here. It's really, really struggling. But when I looked at this chart, and just being a student of history, it struck me immediately that those two periods where momentum wasn't working is the period where there was no growth. So we had this sort of deflationary regimes where in the 1930s, momentum struggled. That was also a low growth deflationary environment. And here we are today, with the exception of US growth, specifically technology and those companies that are benefiting from it. Look around the globe, most benchmarks are still in 20-year secular bear markets. Japan is in a 30-year deflation-driven bear market. So is it coincidence that momentum is struggling during this deflationary period? I'm not sure, but it's quite interesting to me. If you look in the middle of the chart, you can see that momentum lined up perfectly well. I mean, the top decile beat every decile handily, almost once again in rank order of the decile. And that was the other bear market that we experienced, which was an inflationary driven bear market. So it's just interesting to me that during this period where we're talking about momentum not working, it happens to dovetail kind of nicely with the last time it didn't work, which was that deflationary, depressionary environment in the 30s and 40s. And then when reflation hit after World War II, you can see that momentum started working again. So if you think about how cycles work over time, we go from deflation to reflation to inflation to disinflation. You can see those cycles playing out here. If we just completed a deflationary cycle and everybody's talking about us going to inflation and everybody's worried about it, I would argue that we have to go through that reflation phase first. Then we talk about inflation. But from a momentum standpoint, after 20 years of struggling and everybody pretty much chomping at the bit to talk about how momentum doesn't work, I think that if we actually do start to experience some inflation and some growth, we might actually start to see this momentum factor start to generate some returns. So that's one example of what I mean when I say momentum doesn't work, because frankly it hasn't worked more recently. But if you dig into it, what I really mean by momentum not working is it, and again, I'm sure this is a controversial statement, and I'm sure there are many systematic mechanical viewers here that are listening and would take issue with this statement. But I'm just thinking, like, if you have a signal that's telling you to do something, to buy a stock, a commodity, whatever it is, and if that signal is wrong half the time, or sometimes even worse than that, I would say, is that a good signal? I would say it's not. If it doesn't produce accuracy over at least half of their projections, I would say it's an inaccurate signal. But we can look at the stream of returns for the factor over time, and we can see that it quote unquote works. Why is that? This is what I would say. The reason momentum as a factor quote unquote works, i.e. generates profit over time, is not because of the signal. So if you look at I think it's the next chart. Yeah, the next chart, page 4.
The next one.
This is a chart of the SMH semiconductor ETF. And in the bottom panel, this is a chart which you can get on stockcharts.com. In the bottom panel there, you can see Stock Charts' momentum score. It's that black line, kind of like, it almost looks like an RSI indicator. So momentum, as we know, one of the problems with momentum is that it has very high turnover, i.e., because the signal is often wrong, you have to sell the stock. Once you buy, you have to sell it. That's basically the short-term mean reversion problem of momentum. But you can see that as this SMH is trying to make its way up from left to right during, say, the 2017 to 18 period, which is that first red box, you can see how the momentum score falls out of that top decile several times. And so therefore, as a momentum investor, you have to sell that stock, generating that turnover that we talk about. And it's one of the pushbacks on momentum. But contrast that experience with trend following. So trend following gets you to the same stock, which you can see trend following is basically when you have a series of higher highs and higher lows, is a very simple definition. You can see that with that first green arrow. So trend following would buy this stock in that moment. And then it would continue to hold that stock until you have a series of lower lows. Note that during that uptrend, trend following stayed with that stock, whereas momentum was forced to sell it several times. That's what I mean when I say momentum as a signal doesn't work. Momentum as a factor, yes, it does generate profit. Why does it generate profit? If you go to the next page, it's because momentum as a factor has what's called positive skew. Momentum, again, just simply ranking the market, buying the top decile, selling anything that falls out of the decile, and holding on to anything that stays in that top decile. That's basically the process. That very process in itself has built into it a stop mechanism, which prevents left tail events from happening, because as soon as it falls out of the top decile, it's gone. Now it may sell it in error and it will come back up to the top decile again. That's the turnover problem we talked about. But one thing that momentum can't help but do is capture things like Tesla. When Tesla goes above goes into the top decile and stays there for several years, momentum will catch it. But so too will trend following. So it's the point is that because momentum as a factor has such high turnover, I would qualify the signal as not working. So when we credit when we credit momentum with quote unquote working over time, I think we need to be clear that it's not the signal that's actually generating the P&L over time. It's the fact that the process has a positive skew. It won't allow the left tail events to unfold because it's constantly selling anything that falls even a little bit, but it will capture those right tail events, which is critical to generating positive returns for anybody, no matter who you are. That's what I mean when I say momentum doesn't work as a signal.
Yeah. Okay. So then what I'm hearing from you, reading between the lines, is that perhaps there's a opportunity to mix the two or be selective about when you're using momentum. Is that what you're leading to?
That's exactly what I would say. So that, my conclusion is not to say therefore momentum is useless. I actually use momentum quite a bit as an input to what I do. I'm a trend follower, but as I'm trying to determine which trends to engage with, if I'm looking at 4,000 stocks at the end of the day, if in a very robust bull market, you could have, like right now, we have 90% of the market in the S&P 500, 90% of the stocks in the S&P 500 are above their 200-day moving average. That in a trend following world is obviously it's at least on the surface, it seems to be very bullish. The challenge for a portfolio manager is how do you get 80 or 90% of a benchmark? How do you winnow that down to 50 stocks? You can do that with momentum. So if you take all the stocks in the S&P 500 and you rank them according to their momentum, and you only commit to trafficking in the top 3 deciles, that eliminates an awful lot of what you have to consider, because you're really trying to capture, we're all trying to capture those right tail events. And Tesla's not going to be in the 4th, 5th, 6th, 7th decile. So even though it might be in an uptrend, today we have a lot of stocks that are in uptrends, but their momentum scores are down in the 30s and, the 7th and 8th and 9th decile because they're not keeping up with the top deciles. So that's how I think you can use momentum. And I actually have an example of it if you want to go to page 8. So this is just looking at the technology sector broken down by industry. And I have in here, my own tech rank, which has, again, because of my perhaps some would call errant view that momentum is not good enough on its own. In my tech rank, there's a combination of momentum, volatility, price structure, timeframes overlapped, and things like that, all coming into one momentum score. But by doing this, I can look immediately and see that right in the middle of the chart, Internet Network Solutions, there are 10 stocks in that group. It's ranked 19 out of 100 in the short term, 100 being best. It's ranked 3 in the medium term. That, although half that group, as you can see over there on the far right, is in an uptrend according to my model, I'm not going to spend a lot of time looking for ideas there because it's just not the pond I want to fish in. I want to be fishing in those industries within a leadership sector. So I find a leadership sector, which is technology, and then I find the leadership industries within that sector, and then I focus my stock picking, my discretionary chart review process on those best performing stocks within those industries. And by aggregating, literally, this is one snippet that you see here of the 3,800 stocks that I can use this process to scale my research process and come up with a very quick overlay of what's going on. Where is the best leadership? Where are the best trends? By systematizing my research process and putting it in tables like this, I now no longer have to look at thousands of charts a day. I can do it pretty quickly this way, knowing that these models capture what I otherwise would capture looking at things visually. But most importantly, it captures many more things that I would completely miss just because I'm human and I wouldn't see them. Yeah.
So you're talking about using momentum as a universe selection or candidate scoring or something like that for trend following. But at the start, you were talking about how there's periods of time when momentum doesn't work. So do you continue using momentum in those periods, or how does that impact the way you do your candidate selection in trend following in times when I think you said when like periods of deflation, for instance, where momentum really struggles.
Yeah. So I just want to stress that the process at Wellington and what I'm doing today, and I probably just leave it at that because those are the two most clear examples. It's trend following, and trend following is something that works. This is going to be very controversial again as well, but I believe trend following works all the time in the sense that there are different time frames of trend. So, but the idea is that if say it this way, if we ever have a conversation, if we find ourselves having a conversation and concluding that trend following no longer works, this world has much bigger problems to deal with than the fact that trend following doesn't work. Because if you think about it, if trend following doesn't work, that means there are no trends. If there are no trends, trends are driven by economics. Trends are driven by growth and prosperity and progress and things like that. So, trends are an inevitable part of progress and growth. And as long as trends exist, trend following will exist. Whether or not momentum is able to capture that as a factor is a separate question. And I think I detailed some of the reasons why momentum would struggle. The higher the turnover and amongst the deciles is going to cause a lot of issues with momentum as a factor. But as trend following goes, I just showed you an example of like, for instance, the semiconductor index that had a very powerful trend that trend following did fine capturing, but momentum as a factor continued to have difficulty staying with it. So, I don't lean heavily on momentum, but I'm very aware of it. At the end of the day, if I'm capturing something in my trend following process by virtue of that, I'm going to be capturing something that's probably also triggering well in the momentum landscape. But it's not uncommon to capture something that's trending and outperforming by the traditional trend following models, which I think they're on page 4. That would trigger well in a trend following world. It's having a hard time gaining and retaining traction in the momentum world just because of turnover and whatever else is happening within the benchmark and the relative ranking process.
Yeah. Okay, so that first slide you showed us was you broke down momentum into different market environments, inflationary, deflation,
right.
Reflation, I think was in there. What about trend following in specific environments? Do you look at that as well? Do you look at the context of the market environment when you're looking at trend following?
So I absolutely do, and I think that's where. So this is kind of gets to the main reason why while I'm intrigued by backtesting and I try to learn as much as I can from backtesting. I've done a lot of it over the years myself. Where I don't put a lot of weight on backtesting per se is simply because, number one, I'm just not convinced that the data sets that we're backtesting are very reliable. Certainly not pre 1990, 1980. I'm just really suspect of the data, and that's just from my own personal observations of the data and just going through them and finding more errors than I care to find, if to be quite honest. So any backtests that come from data like that, I just have a lingering suspicion about it to begin with. Number one. Number two, I just showed you 100 years worth of trend, and I identified 4 cycles. So we really only have 2 deflationary cycles, 1 inflationary, 1 reflationary, 1 inflationary. So we really only have of the 4 cycles, we have two instances of one of them and 1 instance of the other cycles. Do I really want to put a lot of weight on backtests when regimes determine outcomes? That's the problem. You have situations where quantitative easing changes the landscape and it materially alters what happens in a backtested model, because it just changes. And the problem is you can't detect that change because it's not the impact is not readily obvious on the surface. Whereas like when COVID hits, everybody knows about it and you can see what happened. And it's very easily sort of ring fenced and determine. We can make decisions as to whether or not we should be making changes in our models based on what we see. It's pretty obvious. But when you have QE and you have these other things that are just like very slow at the margin, it's a lot of opinions as to what could and couldn't be happening. It's just not that easy to ring fence and know what to do, assuming you even know what's changing your models. And then, of course, discovering that the regime change is actually impacting the model itself. So I just don't think that if you think about what's the first observation that anybody that makes a back test would say is, what's the data? How far back does it go? That's the correct first answer. I would just say, okay, I have 100 years worth of data, but I only have one deflationary cycle. I only have one inflationary cycle. So but at the end of the day, the reason I'm a trend follower is because you can take everything I just said, and I can just tell you, if something is going to trend meaningfully in a way that I care about catching it, there are 4 things that must happen in the trend following world. They actually have to happen before you can buy them in a trend following space, in a trend following process. And these things are unavoidable. That's actually they're unavoidable conditions that must unfold in trend before you can buy something, and they're guarantees. So you must break a downtrend. You must break the last high of the downtrend. The short-term average must cross the long-term average, and the long-term average must turn higher. Those 4 things must happen. And I don't care if it's a value stock. I don't care if it has high momentum or low momentum. If this stock is going to trend for a sustainable period, those 4 things absolutely, positively must happen. They must happen if you're in an inflationary environment, deflationary environment, I don't care what the cycle is. So as the market, in its infinite wisdom, in its weighing machine type infinite wisdom, it's figuring out all of these changes in the trend, in the shifts in the regime and quantitative easing, the market's verdict is going to appear vis-a-vis this checklist of trend change that I just highlighted. All 4 of those things are going to happen once the market figures out what's going to happen. And by the time we figure it out fundamentally and we can assess it through momentum models, trend following will pick it up vis-a-vis breaking the downtrend, breaking the high, crossing of the averages. And if you can just wrap your mind around the idea that trends happen for fundamental reasons, they happen for money goes to where it's treated best, things like that. If you see a trend changing and inflecting in a time frame that's driven by fundamentals, I think to me that's a durable concept, and it's going to work forever. Controversial statement. It's going to work forever, and on a day it doesn't work, on the day that we can no longer say trend following works, we have much bigger problems on our hands, because that means there are no trends, which means we're screwed. So trend following will work. Sometimes momentum can augment it. Other things can augment it as well. There's a chart here that I think is probably addresses your question as well. If you go to page 11, this is basically using visual interpretation of regime drivers to help you get a sense for whether or not momentum should or should not be working, whether we should be in a bull market or a bear market, risk on, risk off. So the font here is pretty small, so I can just describe it to you. But in the top panel, you're looking at the black line is the 10-year treasury. The red line is a proxy for inflation expectations. That's the TIP ETF versus the TLT ETF. And the other is, I can't even read it myself. Oh yeah, it's the credit. So that's junk versus the TLT. So that's all risk on and risk off. When they're rising, you're in a risk on environment. When they're falling, you're in a risk off environment. And the panel below is banks versus utilities and copper versus gold. And you could even throw in there Aussie yen. That's a great risk on, risk off as well. So you'll note that when you look at those regimes as I have them identified, if you go back and look at what the market did in those various regimes, you'll note that they coincide with cyclical bull and bear markets. They coincide with momentum doing well and trend following, engaging, and things like that. So you can use the feedback from the market and the various trends that are unfolding in related market activity to help you gain a sense for whether or not you as a trend follower should be doing well. And so I think that's one of the most important things that we can do as investors is to really wrap our minds around this definition of edge, which again, I have a slide on page. Well, let's go with page 5 first, because that's the actual definition.
Okay, this one here, is that 5?
One more, please.
I can't see the number there; it's very small. Sorry, I'm going the wrong way.
Yeah, that's okay. So yeah, right there. So in the bottom, you can see edge, and so edge is basically you just basically take your. So back up for a second. This concept of discovering if you have an edge or not is critical. So it doesn't matter who you are. It doesn't matter if you're Warren Buffett or if you're a day trader on the Chicago Board of Trade floor, if that even exists anymore. So, it doesn't matter your time frame, doesn't matter if you're fundamental, doesn't matter if you're quantitative, systematic, doesn't matter. This process you have to face. And so too many people actually go through this gristmill and don't even realize they're going through it. So the concept of edge is basically, and I'm sure many of you are aware of it, is how often are you right times how much money you make when you are right, minus or plus, depending on the sign you use, how often you're wrong times how much you lose when you're wrong. You put those two things together, and if you come out with a negative number, stop doing what you're doing immediately because you don't have an edge, right? Yeah. But the concept of edge, and this is where I think people can get a little misguided and quite frankly, gain too much confidence or gain too much, feel like they're falling apart and they're not doing well, or they don't have, they don't know what they're doing. Is that during a full cycle, the edge, even though you have a full cycle edge and you've determined that over a full cycle, by that I mean a bull and a bear market. I've gone through both of those cycles and I have an edge. During a bear market, what you see the peak in the red bars there, that's the peak of your frequency of small losses. That peak shifts to the left, and you start to incur a lot more losses, and the number of outliers to the right kind of dissipates. And so the point is that when you're not doing well in the market, you need to go through all of your trades, and you need to put them on a diagram like this and determine, why am I losing money? And then say to yourself, if I'm losing money, if I'm not doing well, is it because of something I'm doing? Am I taking too many left tail events? If I am, why? Am I neglecting my process? Is there something wrong with my process? But more often than not, at least for me over the years, when I've not done well, like this year, I came out of the gates, probably one of my best years ever. And then in mid-February, as most momentum investors will tell you, and I actually have a chart here that shows this, momentum just kind of fell on its face in February, and it's been struggling ever since. So in that little snippet of time, I could have been in the very beginning of the year saying, I'm a genius. I'm the best stock picker that's ever lived. And then at post February 15th, sitting here going, I don't even know why I can't believe I just left Wellington. Am I crazy? I just left a good paying job. I'm struggling. I can't make a good decision. But those are the mental gymnastics I would go through if I wasn't really in tune with what my process is supposed to do in different regimes. So if I look at the regime and I can see that the risk on is doing well, but it's starting to roll over, and I can see my if you look at the trend model, which I think was on page, it's on page 8. It was basically that table in the bottom right hand corner. Keep going. So this I put this together when I was going to be on the podcast in June. So I didn't update it because it wasn't relevant. But if I were to update it today, in the bottom right hand corner, you can see that according to this model, 74% of the market was in an uptrend, which is a good number. But you can see that it's deteriorated. It was down 3% from the prior week. If I were to show you this table today, I think it's like 47%. So this is continuing to deteriorate. So if I know that's the case, and I know that the regime is starting to tilt, and I know that the bottom-up structure of the market is getting worse and worse, how surprised am I that I'm not doing well as a trend follower right now? So mentally and from a mindset perspective, I'm perfectly comfortable with the fact that I haven't done well since February, because I understand why I'm not doing well.
Yeah.
And so, what do you do in that case? Well, you trade less. You take smaller bets. You go on vacation. You do things. Jesse Livermore, in his fantastic book, which everybody I'm sure has heard of, is Reminiscence of a Stock Operator. I think he said in that book, there's 2, maybe 3 times a year when you really need to press your bets. Outside of those windows of time, the money is made in the waiting. It's just kind of like sitting and waiting for things to stabilize, normalize, and come back to your process again. So I think from a trend following perspective, if you're a long only trend follower, we're probably in that window where you just need to just kind of sit on your hands and wait for things to get better. If you're a long short trend follower, there's an awful lot of opportunities cropping up in the I guess you'd say in the reopening trade. A lot of those formerly strong charts that were doing really great in the reopening trade, a lot of them have rolled over. So now on the short side, you can actually re-engage on the short side from a trend following perspective. A lot of those stocks still have great momentum ranks because they've still done well. If you look back over the past 12 months, they've done great. So they have a great momentum rank, but their trend is broken. That's the power of trend following over momentum.
Yeah. I just want to dig in a little bit more about these regime drivers. And so you've given us a few examples. You said there were the 4 things that need to happen for a trend following trade to occur. And that was higher highs, lower lows, and then the moving averages crossing above or below each other. And then you've also just given us some data on the momentum rankings here. So do you use all of these techniques personally to define the regime, or are there other things that you look at as well? Because I know things like market breadth are quite commonly used. What are your feelings about that, and what do you use personally to judge the regime?
So I don't lose sight of any of those traditional indicators. But as I said, when I started Breakaway Research back in 04, from 04 to 07, I did a lot of modeling of the market to overcome what I thought were deficiencies in the way we were looking at the market. So things like percentage of stocks above the 200-day average. I think in many ways you can say undeniably that you'd rather have 90% above the 200-day average than 90% below the 200-day. I mean, I think that's pretty clear. That's pretty obvious. But the reality is that above the 200-day average, if you actually go to page 9 as an example, and again, this was as of June, the middle of June, I think. So you can see in this table, what we're looking at is this is something I do every week, and I do it in 3 time frames. But this is my weekly model. And on the left-hand side, you can see the scores, +5, which is the best score, down to -5, which is the worst. And you can see in that week where each of the buckets, how each of those buckets was populated. And in that week, 34% of the market had the best technical rank. So when you say 90% of the market is above its 200-day average, that sounds really bullish. But according to this model, only 34% of them are actually trending. The rest of them are just, it's this knife fight that we all know about. We experience it every day in our portfolios where we can see the benchmark is going up. We see that, but so much is going on beneath the surface. It's just not captured in the fact that 90% of the market's above its 200-day average. So when you drill down on the individual stocks and look at what's actually happening, you can see that only as of that week, 35% of the market was actually trending. The rest of it was either in a consolidation, which would be 1 through 4, or in an actual downtrend, which would be that -1 through -5. So that's one observation. Then the other observation is you take that same model and you look where everything is this week, and you can see what's happened over the course of the week. And you can see that that best model, that best bucket went from 34 to 28. So we have more and more deterioration. And again, if I were to show you this model this week, I think it's 47% in an uptrend, and the biggest bucket today is -5. And I've been watching this. So as the percentage of stocks above the 200-day average is held, I think actually it's a record. We are now looking at a record period of time where the percentage of stocks in the S&P 500 has been above 90 for the longest period in history. I believe that's true. While that's happened, what I'm seeing is an awful lot of deterioration in the market. So what I can then say is, and again, I want to highlight that what this does is this is 3,800 stocks. I can see that in this table without looking at 3,800 stocks. So I'm not going to miss it, but I can assure you that if I went through 3,800 stocks, I'd be sleeping by 1,000 anyway. I would never be able to do it. But by using technology to scale the process and coming up with something like this, it works. So each week, among the many things I'll do, if you look in the bottom left-hand corner, you see that 51. That's 51 stocks that either went from a downtrend to an uptrend or went from a consolidation back to an uptrend. I'm going to want to look at those 51 stocks for sure, no question. But you'll also note in the bottom right-hand corner that 125 stocks are now in the worst trend definition this week that weren't there last week. I'm definitely going to want to look at those charts. And so that's for sure. That's going to direct my attention. And then obviously the high level observation, which we can already see from the fact that it went from in the top left corner from 76 to 74. We can see that we've got an improvement of 51, but a deterioration of 125. This market's deteriorating beneath the surface, despite the fact that we're still in a record number of stocks above the 200-day average. So this chart, this table, and this process reveals to me a lot better that knife fight that we've been in all year long, that you otherwise just can't see by looking at simple things like percentage of stocks above the 200-day average. I mean, I don't want to discount it. It's an important concept, but like the advanced decline line, important concept, but there are so many flaws with it that you can't capture. It's unable to capture breadth participation today like it used to in the 70s and 80s, I would say. So you need to really be creative. I think you need to come up with ways to essentially take the same data, but look at it properly.
Yep. So based on this data in this table here, is this like this week and last week, or is this from a month
This was
ago?
from when I put this together for the podcast in June.
Right. Okay. So
now you would see that by far the biggest bucket today is -5, and a very large part of that is the reopening trade.
Right. Okay. So
and by that, for your viewers, but I'm sure many of you know what that is. But that's the stocks that roared off the COVID low, and shortly after the COVID low, maybe on the retest of that low, we had a whole slew of companies that just took off. Airlines, hotels, car rental, all that stuff. That's where you can see a lot of these violations. Remember that trend following, the checklist of trend change. You're seeing a lot of that table is the checklist of trend change. That -5 through +5, that's the checklist of trend change done in a table, basically. So when I look at that, I know I can think in my mind, I know what those charts are doing. I just don't have to look at all of them. And so that's where we are today. And today we have, despite the fact that we're still 90% above the 200-day average, which is something I don't want to forget, because we are above the 200-day, which by definition means a lot. Something materially bad couldn't happen unless we crash in a COVID scenario again. So any shorts that I do put on, I want to keep my leash short, but I want to put them on. I want to be mindful that we're still in this knife fight. But at the end of the day, things have tilted more negative than what would be perceived to be the case by looking at the S&P 500 or the advanced decline line or these other things that we traditionally lean on.
Yeah. Okay. I've got a question in the chat here from Jeff. I'll put it up on the screen. 1 minute. Thanks for the question, Jeff. Do you take fundamental events into consideration, like Elon Musk speaking, which is happening quite a lot lately, isn't it? But
yeah, I know. So my answer to that question is no, but that's not because what Elon Musk is saying is irrelevant to everybody. It's just irrelevant to me because I'm operating in a time frame that it's just not influenced by what Elon Musk tweets on any given day or anybody else tweets on any given day. I'm trying to capture the trends that are, if you have a pattern and you can't see it on the weekly chart, I probably don't care about it. Right. So I don't look at the hourly chart and I don't look at the 15-minute chart and things like that. But if I was still doing my day job, which was my first job when I came back to the States from Dean Witter, my first job was technical analyst at this company called Technical Data, which has since been absorbed by, I guess it's Thomson now. But my job was to sit in front of, I'm dating myself here a little bit, but it's in front of the Telerate screen. They don't even have them anymore. But my job was to sit in front of a Telerate screen and type trading recommendations to traders on the Chicago Board of Trade floor who were trading the Eurodollar futures, the 10-year, the 5-year. And, I would be looking at tick charts, 1-minute charts, profile charts. So for me, like the hourly chart then is the equivalent or is the equivalent to what I would consider today to be like the monthly chart. If I was still doing that, what Elon tweeted would be all I pretty much cared about. So it's not that it's irrelevant. It's just irrelevant to me, if that makes sense.
Yeah, absolutely. There's another question here from Jeff. Jeff's on fire today. Let's put this one up because you've shared a lot of different techniques. I think Jeff just wants to kind of consolidate it into a process
Sure.
that is a little bit. So can you give an example of what you use to enter a trend, enter a trend trade, and then what are you looking at to exit a trend trade?
So I'll give you the brief overview, but you can. There's a list of books at the back of this at the back of my slides, and in the first 4 books, it's essentially I would consider myself a disciple, if you will, of Jesse Livermore, Nicholas Darvis, William O'Neill, Mark Minervini, and my former colleague and good friend Frank Teixeira at Wellington. Those are the 5 people that I think are among the best ever that do what I do today, and it's trend following at its core. So it's as simple as starting from the top in bucketing the 5 or 4,000 or so stocks into its proper buckets. And by virtue of trend, I can almost always eliminate 1/3 to 2/3 of the market just by bad chart structure, bad relative performance, not even interesting to me. I can then go through the rest of it, what remains, and get rid of all of the industries that are just poor performing industries from a top down level. And just because if I'm trying to pick good stocks, there's been studies that show that depending on where you are in the cycle, anywhere from 50 to 80% of what happens to an individual stock is determined by what happens to the market, what happens to the sector the stock is in, and what happens to the industry the stock is in. So if those things are really drivers of at least half of what a stock is going to do, I want to know what that industry is doing. I want to know what the market's doing. Should I or should I not be pressing my bets? What's the market doing? And should I be pressing my bets in this industry? What's this industry doing? Because they're going to determine what a large part of what happens to that stock. So through that effort, I'll be able to narrow down my list of focus to these companies that are triggering. Like if you go back to that page 9, that table, those 51 stocks are stocks that I would want to go through my process to consider as a new entry. So I don't even have to look at the chart because I know the model well enough. I developed it, but it's that chart there.
Yep.
Those 51 stocks, I know what they're going to look like. They're either reversing a downtrend, i.e. breaking a downtrend line, breaking through the last swing high of the downtrend, the 50 days crossing the 200-day, or the 200-day average is turning higher. Some combination of those things plus a few other things that are in the model as well. That's what's going to trigger me to consider, because remember, I'm a discretionary investor, to consider those stocks as a buy. And then you just take that exact process and flip it on its head. If the industry is starting to deteriorate, if the market's starting to deteriorate, it's starting to trigger negatively in that trend model. It's falling from a 5 to a 4 to a 3 to a 2 to a 1, and then it goes to a -5. Those are the things that are going to trigger me out of a stock. So you just look at that example of the SMH, which was on page, where was it here? Page 4. There's a perfect example of what would get me to consider or get into a stock.
Is that 4? I can't see the numbers. Sorry. So
yes, please. Yeah, sorry. Page 4.
Yep. Yeah. It's that one, I think, isn't it? Trend following versus momentum investing.
That's correct. And I forgot to mention while we were looking at this chart, but the that pink line, that pink arrow that I want to highlight as well is you can see that from a trend following perspective, when at that pink arrow, there is no trend. In fact, it's a risky position right there. It's an overbought range. That's pretty much exactly where you don't want to buy a stock. If anything, you want to take a probing short because your stop is so close. That's how a trend follower thinks. A momentum investor, if you look at the bottom panel, you can see that the momentum score triggered a 90. It went above and it went into that top decile. So momentum would buy that stock. A trend follower would not. That's, again, just another distinction between trend following and momentum.
Yep.
And it's why I'm a trend follower.
All right, thanks, Dave. We've got a question here from RDE. RDE is a regular. Welcome, RDE. Put it up on the screen. What are the systematic rules you apply after running through your discretionary process?
The systematic rules are basically become position sizing, profit taking, raising my stop, chasing a stop with volatility trailers and things like that. So that's all systematic. And to me, that's where I kind of feel like I have to be systematic. So like all of the decisions I make pre-trade, the actual decisions I make are discretionary based on a systematic research process. But I know myself well enough to know that once the stock starts going, I have zero problem selling a stock. If a stock break, I don't care if it's in the ARK fund and everybody loves it, and if it's a meme stock, I don't care what it is. Bitcoin, I will sell it if it violates, because I am adamant about, actually, if you want to look at page 6, this is an actual frequency diagram of my trades from an earlier period.
6?
One more page, please.
One more. There we go.
So you can see that heavy orange line. That's me stopping myself out. I have zero reservation with getting out of a trade. My issue is more about getting out when a stock is doing really well. And I know it's just behavioral bias and everything else, all of which I'm all too mindful of that I have. So I have systematic rules for when to take a partial profit, when to raise stops, and how big the position should be. And that part of it is systematic, not so much because I think that's the best way to invest. Whereas I don't think systematic investing from a momentum perspective is the best way to invest, but I think you should manage your money systematically in terms of risk reward. I'm not saying that's the case. I'm systematic about it because I'm protecting me against myself. I'm just being honest.
Yeah. That's a good
I'm
reason
serious.
to do it.
I thought I was a genius in mid-February. But anybody that I was talking to at the time, I was trying to tell as many people as possible this perspective I had, just to keep my mind in check, that I knew I was over-earning. I knew that this process was not normal, because I know my process inside and out. And I knew that what was happening was just, I was actually concerned that we were on the verge of starting another 99 bubble, because a lot of the other ingredients that preceded the 99 bubble were starting to crop up as well. I don't think that's what came to pass, but that was what was in my mind at the time. That's how good the performance was. And if there's a whole other sort of tangent to the story, but at the time, I had funded some of my own models because I wanted to try systematic investing. And the model is it's just really, really good at finding leadership that is just super durable and will do really well. So I just decided, I'm going to systematically invest in this portfolio. I put it in January. I was going to rebalance at the end of every month. And so I would do half my portfolio that way, and I would do the other half the way I've always invested: long, short, macro, commodities, everything else. Both portfolios were doing well. The systematic one was destroying my discretionary portfolio, so I felt stupid to begin with from that perspective. But when things started to turn over in that discretionary portfolio, I started cutting my positions. I started getting out. I started getting short names and things, but I couldn't sell what was in that discretionary portfolio. I mean, in that systematic portfolio, because I couldn't rebalance until the end of the month. And so I watched a very significant percentage of that profit just evaporate. So that was my foray into systematic investing, which I'll never do again.
Just got a response from RDE saying, thank you. I think many probably can relate to that issue. So yeah, I know we've all probably been through a period where we thought we were geniuses and then got a harsh lesson in reality.
Yeah, what I've come to appreciate, and many have heard this, but I think investing is, if you have a process that works, in the short term, you will never be as smart as you think you are. But you also, importantly, don't forget, you also won't be as dumb. So like right now, I don't feel particularly confident. Like I'm looking at my performance. I'm up a little bit, but it's like the market's up 16% or whatever it is. I don't pay attention to it too closely, but I know I'm lagging significantly the benchmark. And I'm looking at him. I'm thinking, man, I can't believe I got paid for 30 years to do this. I suck at this, But when I look at page 7. This is the momentum factor. This is an ETF that buys the momentum, the top decile. It does a few other things. So this is not a pure replication of the momentum factor. But you can see that there are periods here where the factor has not done well. It's page 7.
Is that 7? I can't see the numbers. I'm sorry. So that's 5, I think.
Keep going. Right. Keep coming.
More.
Right there. That's
one.
it there. So this is the question: is are you supposed to be making money? So here's the momentum ETF. Again, it's not a pure replication of what we saw in the first 3 slides, but it's similar. But what you can see here is that there are periods where momentum just doesn't do well because the market's rotating and leadership's transitioning, and not shockingly, it happens when the market itself is going sideways. So there are periods when momentum kind of like just languishes, and that's Jesse Livermore. You only have to press your bets every 2 to 3 times a year. This is a chart of that. And so today you can see that red box today, how extreme momentum got into the peak in the middle of in February. And now look what it's done since then. So I can sit here and go, okay, I look at my frequency diagram that the peak of my small losses is painfully large right now. I do have right tail events, so I am making money, but it's not nearly as, it's not enough to make me feel like I'm smart, but it is bad enough to make me feel like I'm stupid. But then I look at this chart and I say, well, what do I expect? The momentum is not doing well. Am I actually going to blame myself? So I go through the process. I do go through all my trades and I make sure that I'm executing properly. I do make mistakes because it is discretionary. So I hone in on those mistakes, try to get better at it. This is how I backtest. I don't backtest, as we discussed. I don't backtest 20 years worth of history. What I do is I go back and I walk through every trade I do step by step and just incrementally just try to get better and better and learn lessons, write down my diary and just try to be as disciplined about all of that as possible. And when I look at it today, it's like momentum's struggling. How can I really be too hard on myself?
Yeah. Yep. All right. Thanks, Dave. That's a good point to finish up on. I think knowing when your strategy should or shouldn't be making money is incredibly valuable, I think. So thanks for that. Now, where can people discover more from you, Dave? How can they get in touch with you if they want to?
So we have, I have my Twitter handle, slowly building a presence there. I wasn't able to have one really when I was on the buy side, managing money for institutions. So you saw it there. It's D Lundgren 3333 on Twitter. We do have a podcast that we started at the beginning of the year for the CMT Association. So myself and Tyler Wood we're interviewing CMT charter holders who are thriving with their CMT charter holders. So with their CMT. So we've had the great fortune of interviewing some of the great legendary technicians all the way back, including Bob Farrell, Ralph Acampora, Walt Deemer, Luis Yamada. We just interviewed 2 of the best technicians, I think, in the business, Frank Teixeira, of course, and Jeff DeGraff. We have a couple, Andreas Klenau, I think, was on your podcast at one point.
Yep.
We just interviewed him. I can't recommend his books enough. I think you're going to put my slides in your show notes.
Yeah, we'll make it available.
Yeah, so just maybe highlight it at the back, the last page. There's a whole list of books that I would recommend, and maybe we'll just finish with the most unorthodox book recommendation you've ever had on your podcast, or that anybody's ever heard, and it's the last one. The Advanced Archer: How to Stay Calm at the Center. Has nothing to do with trading, but it has everything to do with trading. And I found the book. I was visiting my uncle in Virginia. We like to go to libraries and go to the section where they're giving away books and selling them for $1. I found this book. It's one of those books that I will read several times a year. So there's an unorthodox one for you, but the rest of the list is must read as well.
Well, that's awesome. I've never heard of that book before, so I'm going to add it to my reading list. I like that. So
I hope you can get it. I hope it's still available.
Okay. Might have to scour some of the secondhand bookshops for that one. Yeah.
Right.
All right. Well, thanks a lot for your time today, Dave. I really appreciate and you sharing your knowledge. And the slides were awesome. So thank you very much. I know you put a lot of time and effort into those. So
My pleasure. My pleasure.
And we're getting some thanks in the chat as well. I've got one final question here from Jeff. Do you plan on writing a book or offering a class?
So it's funny. I would love to write a book, but the truth of the matter is that if you look at the book list that I have at the end, there's 4 books to start. It's Livermore, it's Nicholas Darvis, William O'Neill, and Mark Minervini. Mm. There's nothing I could write that they haven't already written. I would say that. But also, this is over a century worth of successful trend followers. So Mark Minervini was on the IBD podcast the other day, and he made a comment that I just thought was pretty brilliant. He had a whole slew of books behind him. He said, I think it was thousands of books. He said he read them all. But there's a few of them that he read hundreds of times. And what he said was, I would rather read those books over and over again than read one more book. And so I would just say those 4 books, there's nothing I could write that's not in those books. And if you actually read those 4 books, they all say the same thing. It's just what the value is. That's the value. It's 100 years of trend following by successful guys who have actually done it and are doing it today. Mark Minervini is in the trading championship this year, and he's up like 200 and something %, doing exactly what he wrote in his books, right? But Mark Minervini credits Jesse Livermore and Nick Darvis and William O'Neill. William O'Neill talked about Nick Darvis and Jesse Livermore. So it's all the same thing. It's 100 years. So the person I would love to see write a book, just because it would be hysterical anyways, would be Frank Teixeira, my former boss. He should write a book, but there's nothing he could write that these other guys haven't written. So I would just really encourage you to get those 4 books, read them again, and then read them again. That's the best thing I can do, as opposed to write another book. As to starting a class, I actually did have the great pleasure and privilege of actually teaching a class at Brandeis University to graduate level students for about 5 years, and that was a tremendous opportunity for me. I've thought about doing a class and putting slides together. I'm actually considering starting my research product again, because a lot of folks have reached out to me since I left Wellington to restart it, former subscribers and whatnot. So, we'll see. But in the interim, I can't improve on what the other 4 guys have already done and are doing. Mark Minervini, he's on Twitter all the time. It's classic stuff. It's time tested and it's proven over time. Don't even look to me. Frank Teixeira, he's got a public record. He's one of the best of our day, and he's a cookie cutter of William O'Neill. And I'm just trying to be some version of those 5 guys. Just read those books.
That's a great tip. I often read a book 3 or 4 times, and the second, third, fourth time you're like, have I read this book before? Because you pick up completely different points, and some points solidify. I think that's a really good tip. A lot of people just churn through the books and they don't really learn anything, right?
Exactly. And if I could just chime in with one other thing, I know that the time is coming up. I can stay on, so if you want to stay on, we can stay on. But the other thing that you should reread, but you can't reread unless you do it first, is your journal. I've learned a tremendous amount reading those 4 books I discussed, plus the others on the list. But I've learned the most about the most important thing, which is about me, because ultimately, you look in history. I can name a bunch of successful value investors, quant investors, macro investors, trend followers, on down the line. There's many examples from each class of investors that are super successful. So what does that mean? It means that all those processes work. So why are we struggling as individuals? Well, it must be us. It must be what's going on in our heads. So the best thing you can do is to take and write a journal. Write down why you did what you did, when you did it, as soon as possible after you did it, and try to be as verbose as you can. It's difficult to do because in the moment you think there's no value. But when you go back and read that a month or 2 months later, or especially if the regime changes, and especially if you were struggling, or if you were doing particularly well and you feel like king of the world, and you go back and you reread those notes, your learning curve will just be so steep it'll fall over backwards. So read those 4 books that were written over the past 100 years and read the stuff you wrote 2 months ago.
Excellent way to end the discussion today, Dave. So I've got some thanks in the chat. We'll just share some of these and then we'll wrap up today. So BK's a regular. Good to see you here, BK. Great interview. Love the matrix, which reveals what's happening beneath the covers. So
thanks, BK.
BK. Darren, top interview. Pratik, thank you, gentlemen. We didn't get to Pratik's question, but I think you answered it in our discussion. So check out the rest of the recording, I think. Pratik. Richard says thank you. JDE says thank you. One more. We'll put Jeff up here. Jeff asked some awesome questions today. He wins the prize. Well, there's no prize, but good job, Jeff. So thanks, everybody, for attending today. And thank you, Dave, again. Apologies for the tech issues at the start. That's the joys of going
no
live.
Worries.
So now you can tell it's live, not pre-recorded. Yeah. So thanks again. And for anyone who's watching the recording, please don't forget to give us a thumbs up and a comment in the chat. And I read all of those comments. So thanks again, everybody, for attending. And thank you, Dave. All the best. Take care.
Thanks, Andrew. We'll see you now.
Bye-bye.